Hello and welcome. Today, I want to take you on an analytical journey I recently went through. A first-person deep dive into Bitcoin's accelerating supply squeeze and what it might mean for the price. This will be a casual, conversational exploration, with a dash of humor, of why Bitcoin seems to be getting scarcer by the day. We'll unravel how lost coins, ETF hoarding, and institutional hodling are quietly tightening Bitcoin's supply, making it more like digital gold than a trading vehicle. The other day, I came across a headline that stopped me in my tracks. Bitcoin's illiquid supply hit 72%, leaving only approximately 5.6 million BTC liquid. Wait, what? Only about 5 or 6 million Bitcoins are actually available for trading? How is that possible when over 19 million have been mined? My curiosity skyrocketed. I mean, Bitcoin is supposed to have 21 million coins in total. Yet, if roughly 72% of circulating coins are considered illiquid, basically locked up by holders who won't sell, that's like a massive chunk of the supply effectively gone from the market. It sounded insane, like walking into a supermarket and finding 3/4 of the shelves empty, with everyone hoarding the goods in the back room. To a new crypto investor, or even a seasoned one, this kind of news is a mix of confusing and exciting. Confusing, because how can Bitcoin be running out when it's a digital asset? And exciting, because scarcity tends to drive value. Think of vintage collectibles or rare Pokemon cards. So I decided to dig in, and the story I uncovered was more fascinating than I expected. Let's unpack it together. Where all those Bitcoins went, why people are calling this a supply squeeze, and what it could mean for Bitcoin's future. Spoiler, by the end, you might see Bitcoin in a whole new light. My first question was simple. If nearly 3/4 of Bitcoin isn't liquid, where is it? The answer sent me back to Bitcoin's early days and into some deep dive reports. A massive amount of Bitcoin is simply lost. By mid-2025, estimates put the total at over 6 million BTC, possibly hitting 7 million by late 2025, more than a third of all Bitcoin that will ever exist. 1 out of every 3 coins is basically a ghost, sitting in wallets no one can access. How does that happen? If you lose your private key, the coins are gone forever. There's no recovery button in Bitcoin. Early adopters learned this the hard way. You've probably heard the famous stories, the guy who tossed a hard drive with thousands of BTC and tried to excavate a landfill, or people who mined Bitcoin on old laptops and forgot about them. Even Satoshi Nakamoto is believed to hold around 1.1 million BTC that hasn't moved since 2009. Whether intentional or not, that stash is effectively frozen. All of this adds up to a huge chunk of the supply permanently off the market. The more I read, the more staggering the numbers became. Even conservative estimates by blockchain analysts put lost coins in the millions. And each lost coin makes everyone else's coins a little more valuable. As Satoshi once noted, it's like a donation to all remaining holders. Dark humor aside, lost Bitcoin boosts scarcity. It's as if a significant portion of gold on Earth just vanished one day. The gold you have left becomes that much rarer and potentially more precious. Beyond lost coins, some are effectively lost because they are in long-term storage. I'm talking coins that haven't moved in 7, 8, 10 plus years. Many of these belong to early believers or even the hodlers of last resort. These folks took hodl, hold on for dear life, to heart. They stashed Bitcoin away and threw the figurative key in a drawer, not planning to touch it for a long time. For example, wallets holding BTC for over 7 years have only grown in number. By late 2025, the number of coins sitting dormant for 7+ years surged by approximately 422,000 BTC just in that year. It's like people who bought Bitcoin in 2016 or earlier looked at the price now, shrugged and said, "Nah, I'll wait longer." Incredible resolve. And it's not just individuals. Some early corporate adopters also have coins stashed away not to be sold. All this contributes to a picture where a huge piece of the Bitcoin pie is effectively off the table. As of September 2025, about 14.3 million BTC were categorized as illiquid, meaning held by entities unlikely to sell. That's the stat that blew my mind initially. 14.3 million, roughly 72% of the circulating supply, just sitting in long-term storage or lost. Do the math and you see why only approximately 5 to 6 million BTC are truly liquid and trading in the market. Imagine 21 million people at a water cooler that only has 6 million cups of water left. You can bet people start eyeing those last cups. The next piece of the puzzle on my journey was understanding who is holding all this Bitcoin so tightly. It can't all be lost keys and OGs in their mom's basement, right? Indeed, a lot of it comes down to whales, very rich or large holders, institutions, and public companies that have jumped on the Bitcoin bandwagon. What I discovered is that Bitcoin has some serious whales in the ocean now, gobbling up supply and not letting it go. Consider this. Whales and large holders are now absorbing nearly 300% of the new BTC supply that miners create. Yes, you heard that right. They're buying 3 times more Bitcoin than is being mined each year. How is that possible? It means for every 1 BTC miners produce, whales are buying that and also taking some off the open market from existing circulation. They're effectively scooping up coins from other holders, creating a net outflow from exchanges. In fact, exchange balances have been dropping as people and institutions pull their BTC into cold storage. Glassnode and other analysts note that exchange outflows hit historic highs, a sign that folks prefer holding their own keys, reducing sell pressure. It's the classic not your keys, not your coins movement gaining steam, which I'll touch on more when we talk security. Let's put some names to this hoarding behavior. Perhaps the most famous whale is MicroStrategy, a publicly traded company whose CEO, Michael Saylor, became a Bitcoin evangelist. MicroStrategy has amassed a staggering approximately 638,985 Bitcoin on its balance sheet. That alone is roughly 3% of all Bitcoin that will ever exist, owned by one company. And MicroStrategy has made it clear they're in it for the long term. They buy and hold. They even issue corporate bonds to buy more Bitcoin. Talk about conviction. Then there are many other companies and institutional funds holding BTC. By one count, 105 publicly traded companies together hold about 969,000 BTC as of mid-2025, roughly 4.6% of the supply. And that's just public firms. It doesn't count private companies or, say, governments, like El Salvador, who have accumulated Bitcoin. If you include big institutional custodians and funds, more on ETFs in a moment, the number grows even more. One report showed that corporate treasuries plus ETFs held around 2.88 million BTC in total by late 2025, up from 2.24 million at the start of the year, a roughly 30% increase in 1 year. Those are coins basically sitting in vaults, literal or metaphorical, rather than circulating in the market. I found an eye-opening quote from a Fidelity Digital Assets report. By end of 2025, long-term holders and corporate treasuries could control over 6 million BTC, about 28% of the total 21 million supply. Think about the implications over a quarter of all BTC ever, held by entities that just aren't selling. Fidelity's exact words were, over 6 million BTC by the end of 2025, or over 28% of the 21 million Bitcoin that will ever exist. That's huge. It's basically saying more than 1 in 4 Bitcoins is in strong hands by this year's end. No wonder people are talking about a supply shortage. We can see this trend in the data. Glassnode called 2025's illiquid supply a record high. Long-term holder supply, coins held greater than 7 years, keeps climbing quarter after quarter. Fun fact, apparently, long-term holder wallets as a group haven't decreased their holdings since 2016. That's nearly a decade of diamond hands. Even during wild bull runs and brutal bear markets, the aggregate stash of long-term holders only goes one direction, up. As a result, about 95% of all Bitcoin that will ever exist have been mined as of late 2025, approximately 19.9 million out of 21 million. But most of those are sitting idle, and only the remaining sliver is actively traded. Scarcity is getting very real. Now, this hoarding behavior has drawn some colorful commentary. Former BitMEX CEO Arthur Hayes described Bitcoin's illiquid supply milestone as possibly the most bullish signal out there, suggesting it puts upward pressure on price. The logic is straightforward. If demand rises and supply is practically locked away, any new buyers have to fight over a few million coins. And that's a recipe for higher prices. It's supply and demand 101, but on steroids. However, I also discovered it's not all smooth sailing. There are risks and nuances. One interesting case. In July 2025, about 80,000 ancient Bitcoins, 10 plus years old, suddenly moved and were likely sold. These were coins from 2010 to 2012 era that hadn't budged in ages, and when they finally hit the market, it caused a temporary price dip. It's a reminder that even though many are hodling, if some decide to cash out after a decade, it can create shockwaves. Picture a whale that's been sleeping for years, waking up hungry and deciding to feast, or in this case, to sell. The market can absorb it, but it adds some volatility. That said, such events are rare, and the overall trend has still been more coins going into deep storage than coming out. Speaking of volatility, even long-term holders aren't completely immovable, but data shows their conviction is growing. Exchange reserves, the amount of BTC held on exchanges ready to sell, hit multi-year lows in 2025, which signals that folks prefer to custody their own coins. In fact, exchange net flows turn negative, outflows consistently, a sign that more people are withdrawing BTC to their own wallets rather than depositing to sell. This brings me to an important point. If you're going to hold long-term like these whales and hodlers, you better do it securely. We'll get into hardware wallets and safety soon, don't worry. At this stage of my research, I was starting to see Bitcoin less like a fast-paced trading asset and more like a strategic reserve, something you accumulate and hold, like gold bars in a vault. And interestingly, that's exactly what it's becoming for many. Digital Gold 2.0. In the next section, we'll talk about how Wall Street and ETFs are adding to the supply squeeze by locking up even more Bitcoin. But before we dive into the Wall Street part of the story, let me share a quick personal discovery that illustrates how the crypto ecosystem is evolving in parallel to these big trends. While I was deep in the Bitcoin rabbit hole, I also stumbled upon something called Unity nodes, and it's so interesting that I have to share it. Consider this a brief side quest on our journey. One that shows how infrastructure and projects around crypto keep pushing boundaries, even as Bitcoin itself is becoming a hoarded asset. Unity nodes are a recent tool I discovered, and they're basically turning ordinary smartphones into the backbone of a decentralized telecom network. How cool is that? Your phone, not just for TikToks and selfies, but actually helping run a network. The project is a joint venture between Minutes Network and World Mobile, aiming to put parts of the $2 trillion telecom industry on-chain. In simpler terms, Unity nodes let you run a software license on a phone that participates in verifying and improving telecom services. Instead of big telcos using only expensive centralized equipment to test networks, they can now leverage a swarm of regular smartphones running Unity nodes to audit call quality, network performance, etc. in a decentralized way. Every test call or ping your Unity node does is recorded to a blockchain, World Mobile chain, for immutable proof. In return, operators like me earn rewards for contributing to the network's integrity. This is wild because it shows crypto isn't just about finance. It's creeping into telecom and real-world infrastructure. Unity nodes use a software license model. Think of it like purchasing a digital permit to operate a node, essentially an NFT license, though they don't brand it as an NFT, that comes with the ability to run these validation tasks. It's a perfect example of how blockchain can merge with real industries. Phones acting as mini cell towers / validators, and people getting paid in crypto for it. I was intrigued enough that I decided to jump in. I've started with 10 smartphones running Unity nodes, bought the licenses for them. The plan? If it works out and proves profitable, I'll scale up and deploy more. It feels almost like mining, but for telecom data instead of Bitcoin blocks. And the cool part is, Unity nodes pay out rewards in multiple cryptocurrencies. As an operator, you can off-ramp your rewards in supported tokens like BTC, ETH, ADAW, MNT, World Mobile Token, MNT, Minutes Token, and even DOT, Polkadot, which recently partnered into the ecosystem. Personally, I'm opting to receive rewards in a mix of BTC, ETH, ADA, and XR. Be a nice little basket of some top cryptos. After all, if I'm talking about Bitcoin scarcity, it doesn't hurt to earn a bit more BTC on the side, right? Now, Unity nodes are not the focus of today's video, so I won't dive too deep, but I wanted to mention them because they represent how the crypto world keeps evolving beyond just trading coins. While one side of crypto, Bitcoin, is becoming like digital gold locked in vaults, another side is putting crypto into everyday devices and industries in innovative ways. It's a reminder that this space is vast and full of opportunities to explore. If you're curious to learn more about Unity nodes, maybe you have an old smartphone or 10 lying around and want to make them useful, I've linked the project's light paper and a rewards calculator in the description. Those resources explain how the licenses work, the expected ROI, and the tech behind it. Remember, it's a very new venture, so this isn't me saying go all in. It's me sharing something neat I'm trying out as part of staying engaged with crypto's cutting edge. As always, do your own research if you decide to look into it. All right, side quest over, let's get back to the main story. Bitcoin's supply crunch, and now how the big players, Wall Street and ETFs, are affecting it. Another major factor in Bitcoin's accelerating supply squeeze is the rise of Bitcoin ETFs, exchange-traded funds, and other institutional investment vehicles. If the word ETF makes your eyes glaze over, don't worry, I'll keep this simple and relatable. Essentially, a spot Bitcoin ETF allows regular investors and big institutions to buy an asset that represents Bitcoin without having to handle the Bitcoin themselves. Think of it like buying a stock that tracks Bitcoin's price. But here's the key. For each share of a true spot Bitcoin ETF, the fund must hold actual Bitcoin in custody to back it. It's not just paper promises, at least in theory, it's real BTC locked in a vault, often a digital vault, i.e. cold storage. In late 2023 and early 2024, there was huge news. Major players like BlackRock, Fidelity, Invesco, etc. applied for and got approvals for spot Bitcoin ETFs in the US. Fast forward to now, 2025, and we have a bunch of them up and running. The iShares Bitcoin Trust, IBIT, by BlackRock, launched in January 2024, quickly became the 800-pound gorilla of Bitcoin ETFs. Why? Because it's BlackRock, the world's largest asset manager, and they have the clout to attract both retail and institutional money into their fund. Over the past 2 years, BlackRock has been steadily accumulating Bitcoin for its ETF. Get this. Their holdings more than doubled from about 303,000 BTC in mid-2024 to roughly 776,000 BTC by December 1st, 2025. That's nearly 750,000 Bitcoins in one entity's vault. To put it in perspective, BlackRock, through IBIT, now holds more Bitcoin than even Satoshi Nakamoto's estimated stash of 1.1 million. In fact, by Q4 2025, the combined holdings of all US-approved spot Bitcoin ETFs reached approximately 1.3 million BTC. That's about 6.7% of the total supply of 19.5 million at the time. Yes, one chunk of Wall Street indirectly controls nearly 7% of Bitcoin, and climbing. So, what does this mean for supply? It means another huge chunk of BTC is being taken off the circulating market and put into cold storage, this time by financial giants. For example, BlackRock's IBIT uses Coinbase Prime as its custodian, meaning Coinbase holds the actual Bitcoins in trust for the ETF. Those coins are sitting in Coinbase's vault, not being traded on exchanges day to day. And they'll stay there as long as people keep buying the ETF shares and the fund doesn't have net outflows. It's almost like a one-way street. When new money flows into the ETF's manager goes out and buys BTC to hold. When people sell the ETF, if it's just trading on the secondary market, it doesn't immediately release coins. Only if there are massive redemptions or share destruction would they potentially sell the underlying BTC. In practice so far, the ETFs have mostly been accumulating. In 2025, we saw some surprising ETF behavior. There were weeks of heavy outflows early in the year, but overall, BlackRock kept adding to its Bitcoin pile quarter after quarter. By late 2024, it was responsible for roughly 96% of the net increase in ETF-held BTC. Other players like Grayscale and Fidelity contributed, but BlackRock was clearly leading the charge. ETFs create what many describe as a vacuum for Bitcoin. They make it easy for institutions and retirement accounts to get exposure without touching private keys or learning wallets. So when a large fund decides to allocate even a small percentage to Bitcoin, the ETF is forced to go buy real BTC. When several do this at once, they pull coins off the market fast. One analyst noted that BlackRock's accumulation reflects Bitcoin's growing reputation as a hedge against inflation and economic uncertainty. In short, the digital gold narrative is catching on with big money. It's funny in a way. Bitcoin started as peer-to-peer cash, and now institutions are locking it away in giant vaults while traders use paper shares to represent it. Crypto veterans don't mind. Fewer circulating coins tends to help the long-term holder. Let's look at the numbers. Roughly 19.9 million BTC have been mined. An estimated 3 to 4 million are lost forever, leaving about 16 million. Of those, 14 million plus sit with long-term holders who rarely sell. That leaves only a couple million in active circulation. ETFs alone hold around 1.3 million and counting. The liquid supply is shrinking fast. New issuance isn't helping replenish anything either. After the 2024 halving, miners produce only 3.125 BTC per block, about 450 BTC a day, or approximately 164,000 a year. Meanwhile, whales and funds have been buying multiple times that amount in some quarters. They're absorbing far more than miners create. It's not hard to see why analysts call this a recipe for a major price squeeze. Historically, Bitcoin's strongest runs come when demand rises as new supply falls. Think 2020 to 2021 with PayPal, Tesla, MicroStrategy, and Grayscale buying aggressively. Now we have all of that plus ETFs and a higher share of long-term holders. Of course, supply isn't everything. If demand dries up, prices won't magically rise. But the broader trend points toward growing interest from both institutions and everyday investors who now view Bitcoin as a store of value rather than spending money. That shift mirrors gold. Most gold sits locked away and rarely moves, yet its price stays high because the tradable float is small. Bitcoin seems to be following the same path. Illiquid supply is at record highs, showing that more people are choosing to accumulate and hold. One article summed it up well. Bitcoin is evolving from a speculative asset into an institutional store of value. With rising scarcity, we may see higher long-term price floors and also sharper short-term moves, since fewer coins on exchanges can mean bigger swings when large orders hit. In other words, Bitcoin is entering its true scarcity era, and we're watching it happen in real time. Now, before I continue, I want to drop a quick but important disclaimer. Disclaimer: I am not a financial advisor. The content in this video is for educational and entertainment purposes only and should not be taken as investment advice. Always do your own research before making any financial decisions. Also, know that some of the links in the description, like my Ledger affiliate link, are affiliate links. If you use them, I may earn a small commission at no extra cost to you, which helps support the channel. I only recommend products I personally use and trust. All right. With that said, let's pivot to a critical part of this journey, securing your Bitcoin. Because what's the point of learning about Bitcoin's scarcity and value if you don't protect the coins you do have? The last thing we want is your Bitcoins becoming part of that lost forever statistic. By now, you know that millions of BTC are lost due to people misplacing keys or leaving coins on vulnerable platforms. And we've talked about how more folks are withdrawing coins from exchanges to hold them privately, self-custody. If you're new to crypto, you might wonder, why not just leave coins on an exchange like Binance or Coinbase? Two main reasons: security and true ownership. First, if your coins are on an exchange, technically you don't own them in the strictest sense. The exchange does. You have an IOU that says they owe you XBTC. If the exchange gets hacked, freezes withdrawals, or, knock on wood, goes bankrupt, you could lose your funds. We've seen it happen. Mt. Gox, once the biggest Bitcoin exchange, lost most of its customers' BTC in a hack. More recently, the collapse of FTX in 2022 left users in limbo for getting their assets back. The saying in crypto goes, not your keys, not your coins. That means if you don't hold the private keys, which are like the password to unlock, spend your Bitcoin, you're trusting someone else. And trust, as history shows, can be misplaced. Second, even if the exchange is perfectly honest and secure, simply by leaving your coins online, you're exposing yourself to phishing and hacking risks. Your account could get compromised via SIM swap, an email hack, etc. It's generally safer to keep your long-term holdings in cold storage, which means offline, away from internet threats. Enter hardware wallets. These small devices store your private keys offline, keeping them out of reach from anything on your computer. Ledger is one of the most popular options and the one I use. Think of it as a tiny vault. When you send crypto, the device signs the transaction internally, so your key never leaves the hardware. Even if your computer is compromised, your keys stay protected. Using a Ledger or any reputable hardware wallet adds a major layer of safety. If you're planning to hold long-term, this is step 1. Back up your seed phrase carefully and don't leave coins on exchanges longer than you need to. Exchanges are fine for trading, not for storage. One important warning: only buy hardware wallets from the official site. There have been cases where people bought new devices from third-party sellers that were tampered with. They moved their crypto over and instantly lost it. Avoid that risk entirely. Stick to Ledger site, Trezor site, or another verified source. I do have an affiliate link to Ledger on my website, and if you choose to use it, it supports the channel at no extra cost. But there's zero pressure. The priority is that you get a real device from a trusted seller and secure your coins. As Bitcoin becomes more valuable, the incentive for thieves grows. That's why a hardware wallet matters. Treat it like your personal Fort Knox. If the setup feels intimidating, don't worry. Ledger Live walks you through it, and we've got a community ready to help. Which brings me to the next resource. Before we wrap up, I want to invite you to our free Discord community. The link's in the description. It's a friendly place to ask questions, get help, and learn at your own pace. Whether you're wondering how to set up a ledger or what a Unity node actually is, you'll find people happy to explain. Crypto is complex, and having a community makes it a lot easier and a lot more fun. Stepping back, it's wild to see how far Bitcoin has come. We started with a simple question about a supply squeeze, and it led to a much bigger picture. Millions of coins are gone forever, shrinking the real supply. Long-term holders and whales are locking up an all-time high amount of BTC. Companies and institutions are treating Bitcoin like a reserve asset. ETFs and Wall Street channels are buying and storing even more. And new issuance keeps shrinking with each halving. All of this shapes where Bitcoin is today and where it's heading. The big picture is clear. Bitcoin is becoming a scarce, hoarded asset that acts more like gold than internet money. People hold it as a hedge, a long-term bet, or a store of value. The old buy pizza with Bitcoin era is long gone. Its fixed supply is starting to matter in a real, visible way as more coins move into long-term storage. So what does that mean for us? If you're investing, this context pushes you toward a long-term mindset. It also explains the volatility. With a shrinking tradable supply, prices can swing harder, but downturns sometimes hold higher floors because many holders simply won't sell. And as supply keeps tightening, entry points may only get more expensive over time. It's also a reminder of how much conviction is in the system. Millions of people and institutions are choosing to lock up their coins for years. That behavior doesn't come from folks who think Bitcoin is going away. Their collective holding helps create the scarcity that could support future value. Nothing is guaranteed, of course. Big holders may take profits and institutions might sell under pressure. Stay grounded. But the structural trend toward scarcity is hard to ignore. That's a wrap-up. I'm excited for what comes next. Bitcoin is settling into its role as a long-term store of value, while new tech like Unity nodes shows how fast the broader crypto space is evolving. It's a rare mix of innovation. If you made it this far, thanks for watching. I hope this clarified why people talk about a supply squeeze and how it shaped my own perspective. If you liked the deep dive, consider subscribing for more crypto content and maybe check out the next video next. See you in the next one, and happy hodling.